Hi everyone, ton of stuff going on out there. I think one of the big issues that we've got, because we're pretty bearish here on oil, is this whole debate about there's no geopolitical risk priced in oil, and we actually think we're in an opposite situation. So our view is that if you look at refining margins, for example, a 5.32 crack on the Gulf Coast, they imply that oil should be about $10 a barrel lower, and that weakness in refining is really what concerns us. The fact that there's a major overhang of spare capacity in global oil also underlines the fact that crude is being artificially held high. Now, of course, there are major geopolitical issues out there, but so far the response of both Russia and Iran to major threats, essentially, has been extremely limited. The invasion by Ukraine of Russia is kind of crazy. I mean, it's the first Russian land invasion since the Nazis. And in fact, Kursk was the site of one of the biggest wars in history, battles in history. Estimated 500,000 to 1.5 million Russian Soviet troops died, not to mention the Germans. Incredible range of uncertainty on the number of deaths, but really a bloody area, and one that we're watching very closely. At the same time, Iran really hasn't done much in response to Israel assassinations. Israel's also shown itself capable of bombing Iran by bombing the Houthis, which is about the same range. So there's really a standoff that's going on in both cases of very active hot zones, and one to watch. But we think that it's already priced into oil, because oil should actually be lower based on what's happening in refining. Now, it's not all doom and gloom out there. Asian LNG is doing very well on hot weather. We're going to have to get accustomed to increased seasonality that shows strong demand peaks in summer. But of course, for natural gas, winter will remain the major driver of demand, particularly in the US, and winters are coming in warmer with global warming. So the natural gas outlook to us remains very challenged, and it's not demand which is doing very well, it's the supply side, which is the same in oil. You have really large amounts of spare capacity in US gas. The producers have curtailed production, which has helped prices, but they can always just bring the production back, and the same applies to OPEC. The concern, as you know, with OPEC for us is that there's a fraying of the discipline between Saudi and UAE, which is the true core of OPEC. And once the UAE goes into production growth mode, you're really left with the Saudis to decide what to do next. And we think ultimately they're going to have to probably face a market share war, especially if refining remains as weak as it is relative to recent history. Refining overall is not the disaster that we've seen at times, but we are in 3Q, and that's what we keep warning. Watch out for what things look like by the time we get to January. Earnings estimates are beginning to get cut, but they need to come down more. One of the issues out there with Asian LNG being strong on hot weather is that at the same time we've got very weak Asian refining, and if you look at one of our favorite indicators of refining strength, which is regrade margins in Singapore, which is to say the premium of jet fuel over distillate, really there isn't one at the moment, which indicates weakness, and we all know that China is wobbling, and that of course is a major issue for any bull case on oil. Whatever happens in China, it's impossible to see them returning to the growth of the past 20 years, and that tends to be the pattern globally, with US also weak relative to history. So we're just well off the highs that we saw in 2019 for demand, and we're not going back there in our view. One of the areas which is really interesting, because it's so important for the energy transition, is California. And we had news from California this week that was interesting. First of all, gasoline demand is weak, which is not a surprise. EV sales are now 25% of vehicle sales, and as a result, you can see a situation where gasoline demand continues to decline. More importantly for us, there's a really interesting dynamic that 60% of California diesel demand is now met by renewable diesel, 60%, and that's a big deal. You also, of course, have negative power prices midday in California because of excess solar. So really a lot of this indicates where we're going, and one aspect of California that's less well recorded, but which is a fact, is it's pretty much the most jet fuel intense major economy in the world. And the Californian Air Resources Board, which made a big decision this week, isn't really doing anything about jet fuel. What they did do is they tightened the carbon intensity standards, because there's an excess of credits being generated. And that's been a benefit to one company that we highlighted this week, Darling Ingredients, which provides feedstock for renewable diesel. That one benefited from what's a tightening of the standards for renewable diesel in California, which has been a big benefit to what's been a suffering market. California refining margins remain very weak because there are more threats. Not only is distillate very heavily renewable diesel now, but also Asian refiners are exporting Canadian crude, or rather importing crude from the new TMX expansion west of Canada, and sending the product back to California, and that's further adding to the pressure on California margins, which normally are the best in the US and right now are the worst. Not as bad as Asia though, so there's a lot of concerns about refining. US natural gas, we mentioned, also has major capacity overhang. Although the producers have curtailed production, we're concerned that they can just restart production when the price gets towards $3 per MMBTU. And with the delays that we're seeing in LNG projects, for example, Exxon's Golden Pass, Sempra has a delay as well. In Mexico, we're in a situation where we just don't see the bull case for natural gas through 2025, which is about the same time frame that we'll get a decision on Chevron for Hess. And as a result, we're basically liking Exxon here and quite negative on Chevron relative, simply because this overhang will take so long to clear. But of course, Chevron's also had a couple of dodgy results since they announced the Hess deal, which was further damage to Hess shareholders, who now will have been negatively surprised by how long this arbitration is going to take to clear. It won't be done until Q3 2025 by all accounts, which is about the same time frame for Exxon's Golden Pass to start. We think the arbitration will be decided before Golden Pass, but that's not really saying much, because a year is a long time on Wall Street, and we're a year away from either of those two things happening. One thing that we do like is midstream US, where we see the bottlenecks, because if you look for bottlenecks, we're not seeing bottlenecks obviously in oil, refining, chemicals is oversupplied, US natural gas is oversupplied, global LNG is tight, European natural gas prices are reacting to the tightness in Asian LNG. So that's one area of brightness which will remain bright, and we like a defensive name like Cheniere here, LNG ticker, as we are in a defensive mode, which is why we like Exxon. We still like the Permian players like Diamondback and Permian Resources, but we are warning on Oxy because it's clear that Warren Buffett has stopped buying shares at his trigger point of below 58, and that's been a huge prop to the stock, which looks relatively expensive to us. On the midstream side, things like Energy Transfer, Plains All American, Enterprise all look great, because the problem here is prices, not volumes. Volumes remain extremely high, and we keep setting new records for global oil demand. I don't think we're going a whole lot higher than this. I don't get the major bull argument for oil as long as China is doing what it's doing, and I think it will continue doing that. But ultimately, the midstream of the US looks like a very good place to be for us. And of course, the one area where there's a real bottleneck globally is electricity in the US. You're already tight for supply. This AI arms race is going to continue apace. As oil analysts, we look at it and we go, my goodness, whenever an industry goes from $20 billion of annual spending to $100 billion of annual spending, it's always a disaster. We haven't seen tech companies spend at this level in their history. We have seen oil companies do it, and it ends in disaster. So watch out for that. Having said that, the tightness in US power supply does lead us towards the fairly obvious trade of liking IPPs like Vistra, Constellation. We've highlighted Talon. I should have done more with Talon. I was given the heads up on it when it was still in bankruptcy, and while we highlighted it a couple of times too early, we missed the big move. Now we're talking about it again as a nuclear-fired IPP. Seems a good place to be. And then in the picks and shovels, we like Eaton. Again, we're late on that call. The graphs look very aggressive here, but nevertheless, Eaton and GE Vernova making turbines. You might remember that Rob West was on our happy hour a couple of weeks ago and was saying that the price of a combined cycle gas turbine is up 70% in the last year. That's a great example of where the capital gets eviscerated when companies get into an arms race, such as you have in big tech. It's all quiet here. The action is dwindling away as we head into August. The NVIDIA results on the 28th of August keep everyone at their desk. Unfortunately, it's very rude of them to report in the last week of August, but what can you do? In the meantime, we're very defensively positioned. As I mentioned, we like things like Exxon, Cheniere, midstream, and we believe that oil is basically $10 overvalued with a geopolitical premium already in it. And chatter today, just alone today, suggests that Qatar has been telling Iran not to respond until negotiations are complete with Israel, and we're not seeing any response from Russia to the first land invasion since the Second World War of Russia That's been very muted as well. So there is geopolitical risk out there. It's just with the spare capacity that we see in global oil, we don't see a path, even with Libya falling apart again, we don't see a path for a really tight oil market here, really until US production starts declining for oil, and it's just not declining. Okay, have a great week. Thanks a lot.